With me now is Mahesh Patil of Birla Sun Life Mutual Fund. Mahesh, thank you so much for joining us. Can you just tell us what do you make of the recent rally in the market and where the reality is on the ground? Is there an economic pickup which will soon be reflected in the markets?
So the rally in the market is driven by two factors. One is what we have seen on the global front. Things have been pretty upbeat despite the Brexit and the recent chances of Fed increasing interest rates. The liquidity flows continue to be pretty strong, and more so in the emerging markets, what we have seen. And we've seen the liquidity-driven rally recently. But having said that, I think on the fundamental side also, I would say that things are kind of improving. Clearly, we saw the last quarter numbers was pretty much in line with expectations. But I think on the policy front, we are seeing a lot of developments happen in the last 6 months, which will have a multiplier effect on the broader economy. The monsoons have been good, so give a push to the rural economy. Consumption would, I think, pick up in the second half. That's what we are hoping. And that should drive earnings growth going forward. So while the valuations could look slightly expensive from a historical perspective, and that's a question which normally people ask, but I think one should look at valuations in terms of perspective, in terms of the cycle where we are in, either on the earnings cycle or the business cycle. So we feel that the earnings are still pretty depressed compared to historical levels. So we are now no longer, like for example in 2008, okay, when we had a big tailwind, we have seen a big earnings cycle behind us. The ROEs were at its high. We are at a time where the earnings growth in the last 5 years has been pretty tepid in kind of single digits. Our ROEs are also at a kind of a 7-year low. The profit as a percentage of sales is also at a 7-year low. So the earnings are clearly depressed, and the growth as the recovery happens could be much stronger than what we have seen in the past.
And that's particularly the reason why the PE is looking slightly expensive, because the earnings have been depressed. People have forgotten that markets can grow at 18-20% earnings.
So I think it's partly because of that, and partly also the fact that there has been enough liquidity around the interest rates. We are a scenario where globally we've seen kind of a zero interest rates or negative interest rates. In India also we have seen that the rates have come down, the risk-free rate has come down. So obviously your cost of equity has gone down, so which will justify a slightly higher PE multiple. So it's a combination, I would say, of interest rates going down, of higher liquidity, and the fact that the earnings growth is likely to improve. So it's a complex thing, but it's a combination of these factors, I think, which one should look at when one is looking at valuations.
When you operate a fund and it's more of a stock approach for you. As a policy, I know you don't comment on stocks, but how would you essentially look at things like Fed rate hike, probably Brexit, crude prices returning to $55-65 a barrel? How would that impact? Would that impact be very, very short-lived?
So I think these are all macro. I don't think it really, when you do into the macro, I think, yeah, it does impact. So you can probably break it down into some of the global. Okay, so there are stocks which are linked to the global economy or the global growth. So some of the global factors would come into play. So you would have some view in terms of how the global growth would be, which is not looking exactly too great. So obviously you would want to be slightly underweight, or probably want to give a lower multiple for stocks, okay, which are linked to the global growth, because growth will be slower. And then you come back to these stocks which are more linked to the domestic economy, where there are multiple triggers, okay, which could play out and will look better, and one would want to be in those sectors. So that's the way I think one would look at from a macro perspective. But then when you look at individual stocks, really a lot of these things don't really matter. I mean, they lead to short-term blips into the markets which could impact the stock prices, but we see them as buying opportunity as long as our assumptions on individual stocks are not really impacted by those variables.
Right. Recently we've seen a lot of announcements from governments, especially for the infrastructure space. Now that's a space which people have clearly forgotten. Nobody wants to own companies where there are stalled projects, slightly higher debt. You think that will change slightly, because a lot of work has been done? So maybe in the next 12, 14 months or 24 months, we may see some sort of companies doing very well.
So I think infrastructure again is a pretty large space. I mean, you've got pockets of, I mean, the power sector, within power generation, power T&D, we have the road sector, railways. So it's a pretty diverse. I'm not, I mean, necessarily seeing all these segments doing equally well. Obviously, the road sector and railway, we are clearly seeing an increase in investments, new ordering starting to pick up. So obviously, companies catering to that segment directly or indirectly will benefit from that. And on the other hand, the power generation sector, there is excess capacity which is there. One doesn't expect any new big capacities to come up, at least in the medium term. Similarly, in the metal space, because of the global weakness, we're not seeing any big capex over there. So I think it's a kind of a mixed bag. I think we have to look at areas within the sector where the investments will pick up. But I think clearly there is enough which is happening. There is enough liquidity which is there, because a lot of these sectors require a large amount of capital. I mean, while the government has stepped up its expenditure, if you look at in the budget, but that is very minuscule. I think a lot of money has to come in from the private sector through multilateral agencies, and as that money starts to come in, only one can see a bigger growth in this sector. But at the same time, I would say that companies with high leverage and this thing is something which would still struggle, because there's not such a big opportunity. So, and the balance sheets will constrain them to really be able to capture that growth. So I think we'll still stick to companies which have got a pretty decent balance sheet to be able to capture the opportunities which will come in the sector.
Right. IT, just a last word. As far as IT is concerned, most of the funds are underweight on IT. But, don't you think valuations are getting to a level which are very, very attractive? Or do you believe that the growth over there would be lower for a very, very long time?
The IT sector has seen downgrades in terms of the trajectory of growth, what it has seen more recently, because of a global slowdown, also the shift in technology, how things are materializing. Europe is seeing some slowdown over there, and the growth rates have come down for the industry as a whole to around 10 to 11% or so, clearly 200 basis points lower than what one was expecting, say, around 6 months back. So to that extent, I think there has been a derating in the multiples, but the sector would still be steady. I mean, one doesn't expect a dramatic decline in earnings. So to some extent, I think there's a recalibration in terms of the multiples, what we have seen in the marketplace. But I think the return in the sector would also be kind of tepid. One can't, since the growth in the broader economy would be much stronger than this thing. So in the relative terms, the sector growth would be lower, and but a lot of these companies are still good companies, strong management, generating good cash flows. So you would, as a portfolio approach, you would still like to have that in a portfolio to give them stability, and at certain valuation underperformance, there could be some kind of a catch up which had happened. But clearly, I think the lower multiples in the sector are here to stay, looking at the lower growth. And if there is the rupee tailwind is not there, then one could even see some margin pressures coming into the IT sector.
Just a last word on which sectors would you be overweight on, say, for the next 12 to 24 months? Just any top 2 sectors and in the order of preference.
So we still continue to like the banking and financials. Within that, the NBFCs and the private sector banks. That's one sector. And playing the whole consumption theme going forward, which has been a long-term theme in India, more so on the consumer discretionary side. Either it could be played through the auto sector or through the media space indirectly. So these are the 2 sectors which one would like to play. So I think consumer discretionary and the banking and financials are the 2 sectors where we are an overweight, not next one, but for the next 2 to 3 year perspective.
Thank you so much, Mahesh, for taking our time for us. Always a pleasure talking to you.
Thank you.
Thank you.